Hello and welcome to this latest edition of Courses on Demand brought to you by Forex Academy. So in this course, we'll be looking to provide you with a pretty comprehensive introduction to what's called Elliott wave theory. So just before we begin, there is of course inherent risks involved in trading the financial markets. So please do take a brief moment to familiarize yourself with our disclaimer. If you do need to stop or pause this recording, do feel free to do so. Okay, so let's start with a very brief webinar outline. We'll start by giving you an introduction to Elliott wave theory. We'll explain the origin of Elliott wave theory and a little bit about him and how this whole theory came about. Then we'll have a look at the actual Elliott wave theory itself, and it's referred to as the 5-wave pattern. Now, within that, there is what's called impulsive waves. We'll have a look at those. We'll have a look at corrective waves, and the fact that these wave patterns do repeat themselves. And of course, there is variances on these waves as well. So you can have a situation where you can have a series of waves even within waves. So all this will become very transparent very shortly. We'll have a look at Elliott wave theory in practice as well, so you can see it on a price chart. And we'll finish by just looking at some of the difficulties that traders can have when applying Elliott wave theory. Okay, so let's start with an introduction to Elliott wave theory then. So what's important to be aware of is that Ralph Nelson Elliot, and I'll put a picture of him up on screen, developed the Elliott wave theory in the late 1920s. Now, he believed that the markets, who many believed behave in a very erratic manner, actually trades in more of a repetitive cycle. So to give you a bit of background behind Ralph Nelson Elliot, he was born in 1871 and he died in 1948. He was a US Treasury accountant. Now in his 50s, he began to study stock market data, looking at price action. And he observed that stock market prices trend and reverse in recognizable patterns. And this, of course, then was able to give birth to his Elliott wave theory. So to just encapsulate what the Elliott wave theory is, now this is a theory which suggests that market moves in clearly defined sequences of highs and lows in a very repetitive manner. So the Elliott wave theory studies the movements of these sequences. So at this point, I'd like to bring up just a fairly generic price chart, because there is a couple of things before we begin that we would just need to point out to you. So firstly, it's just important to know that, or to recognize the Elliott wave theory as a technical tool, effectively, which is used exclusively by technical traders. And what it sets out to do is also as well, it's important to embrace the fact that markets are continually prone to trending and reversing, i.e. they do not move in a linear fashion. And this particular chart is just a typical example. It is a US dollar monthly price chart. But what you can see is that this chart can move in a particular pattern, either to the downside or to the upside. So it can go through periods of trending lower in a very repetitive fashion. And of course, you can get slight reversals of that, where you're getting pullbacks in price action off those levels. And then you can reestablish these trend patterns. So this is what Elliot was interested in, is identifying and trying to understand what is going on with these market movements. And of course, the same applies to the upside. You can go through periods of price action and of course be able to identify the pullbacks as well, so that these markets constantly go through periods of trending either to the upside or to the downside. So you could have this trending market on a number of occasions trending to the downside, and therein lies potential opportunities for your bears to look to sell this market, and you also get these opportunities to buy these markets as well for your bulls. So markets never move in a linear fashion. They do not move in straight lines. So we have to acknowledge that markets move in trends and they reverse, and then they can move in trends as well. They can go through also periods of consolidation. So this is just the nature of the way that the markets operate. So that's just a little bit about just a brief introduction to Elliott wave, because we'll explain it now in considerable more detail. And we'll start with the basic principle of the Elliott wave theory is the 5-wave pattern. Now, what this suggests is any major movement will unfold in a pattern of 5 waves, and in turn will be corrected by a pattern of 3 waves going in the opposite direction. So just imagine this diagram here in the middle of your screen represents price action and the movement of price, and we can identify that this market creates a high at price point number 1. You can see it then pulls back to 2, it moves higher to 3, it then pulls back again to number 4, and then this market seems to peak at the 5th wave, which is the 5th impulse pushing prices higher. And then look at what happens, because the 5-wave movement can be split into 2 distinctive segments, and we'll look at each segment very, very carefully. But what happens after we see a price point there on screen at 5, at the 5th wave, we can then see that the market it reverses and it makes a low at point A. It then tries to push higher, fails to make a new high, and makes a high at point B, and of course makes a 3rd wave pattern to the downside in the opposite direction of the initial move. So this is your impulse and this is your correction. So what Elliot would do, and he'd be analyzing a lot of price data, is he'd be identifying these patterns existing in the markets, either on the impulse side and then looking at the correction side. And what he suggested was there'll be interesting opportunities at these points if you can identify them, for opportunities to buy these markets at these levels. And if you can identify 1, 3, and 5, what it will do for traders is potentially give them an opportunity, in this case, to sell the market and benefit from this reduction or pullback in price action. And you can use this 5-wave pattern to do that, followed by a 3-wave correction. And that is the basic premise behind Elliott's wave theory. So we will apply this technically in a chart very shortly, but I do want to just focus a little bit more on the impulse wave, and it's being able to identify these 1 to 5 waves, which we've just highlighted there in the box. So this trend phase is known as the impulse phase. So we're getting impulses to the upside on numerous occasions. And I shall just briefly change the color. So we're getting these impulses pushing prices higher from these points on a price chart. And this is the essence of the impulsive segment of this particular wave. So we're getting that trending price action pushing prices higher. So this is the numbered phase. So the first 5 phases are actually broken down as the numbered phase. So you're looking for 1, 2, 3, 4, 5 wave patterns on a chart. And an impulsive segment, 1 to 5, is itself constructed as a series of 5 waves, of which 1, 3, and 5 impulses are of a minor degree. So we're experiencing a nice sizable move in price action from the low to the outright high, and we're able to identify with our understanding of this impulsive segment or the impulse waves and we're identifying potentially tradable opportunities within that. Okay, so that's just a little bit about the impulse wave. So moving on to now the corrective wave, and we're again going to look at the same representation of price action, but actually there's a little bit more to the corrective segment, the corrective part, or the corrective wave elements of this particular Elliott wave theory. So trends move in a series of peaks and troughs, or highs and lows, and other technical analysts would refer to one as a high, would refer to 2 as a low, would refer to 3 as a higher high. I'll do it in a slightly bigger. Would refer to 4 as a higher low. So really, it's just a slight change in terminology, and this number 5 would be a higher high once more. So as price drives to the upside in phase 1, up to phase 3, and up to phase 5, this the corrective wave actually focuses at the parts of the wave which result in prices pulling back. So we also have the lettered phase as well, is known as the corrective segment, and is always counted in 3s. So whereas we're looking for 5 waves to the upside, and you would also be looking, if you're applying Elliott wave theory, 3 waves to the downside in this particular example, and they're always counted in 3s. And to differentiate between the impulsive and the corrective wave, we're now looking at ABC in terms of a price move. So highlighting wave number 2 and number 4 of the impulsive phase are also corrective waves, because those are the lows that are created because of a correction of price, and that just means we get a pullback to that low, and that creates our wave number 2 and wave number 4. So once we satisfy that, we see wave 1, then we see wave 2, we see a push higher at wave 3, we see the pullback at wave 4, then this constitutes the Elliott wave theory, where you make a high at 5, and then you see the reversal in that price action, or the corrective segment, or the corrective wave. So in addition to that, waves 2 and 4, as a result of the impulsive phase, are also corrective waves. Wave 2 corrects wave 1, so we're getting this push higher. So this low here, it corrects the price action, because we don't see price action moving in a linear fashion. It does move in this impulse to the upside, followed by a pullback, followed by a further impulse, followed by a pullback. So it's just following that as a narrative, but being able to visually identify it on a price chart. And we'll have a look at some price charts very shortly to show you this in a little bit more detail. So just be aware that wave 2 corrects wave 1, and of course wave number 4 corrects wave 3. So the correction always comes after the impulse, and ABC is the corrective phase of waves 1 to 5. So this is the corrective segment now. Wave 2 and 4 is the individual correction, and then we enter, once prices peak at 5, we then enter the corrective segment, creating an A, B, and C corrective wave in this example. Now, other tools can be used to help identifying where a market will pull back. For example, fib levels. So, those that trade the market using technical indicators that may use fib levels, they might draw a fib from the low, the recent low, to the recent high, and they might be able to gauge where this price action will actually pull back to, even at point A, the first corrective wave, or point C, which is the second corrective wave pushing lower. So that can just present with opportunities for traders to actually look to engage with the fib, and there's obviously many other trading indicators as well which can be used in a similar fashion. that can support the understanding as well of Elliott wave theory. So moving on then to the fact that what's important when you understand the complete structure and you can identify these 5 wave patterns, and you can see them in every chart in some capacity. It's important to understand that you can experience with a very volatile moving chart that waves can repeat themselves on multiple occasions. So you can get these smaller waves existing, and these, you get your 5 wave impulse followed by your ABC wave correction. And this has the tendency to repeat itself on many occasions, especially if we're seeing if we're in a bit of a trend and prices are pushing higher, again followed by your 3-phase correction. So the idea is that you can actually get many multiple opportunities of wave repetition, and it can effectively give you a little bit of foresight. It's important to notice what happens in this little phase in here, because what we're seeing is a reversal in price action where we're actually creating a series of repetitive waves to the upside, followed by a series of repetitive waves to the downside in this particular side of the 5-wave pattern. So this time we're creating a 5-wave pattern to the downside, followed by, again, just to reiterate myself, a 3-wave corrective ABC pattern, and then that rolls in once more to an additional impulsive wave, but this time to the downside. So it is important to take on board the Elliott wave. It can be very useful in certain capacities to be able to analyze and see what's going on. And of course, what you can also, and this is where Elliott wave can start getting a little bit more difficult, but you can also have larger Elliott wave signals, even over and above your smaller waves. So this is effectively a 5-way signal, for example, perhaps even on a much bigger time frame, and you get your corrective phase as well. So it's just basically having an understanding of all of these aspects of the 5-wave pattern when it comes to Elliott wave theory. Okay, so moving on then to the principle of, and we've kind of alluded to it already, is the fact that you can find waves within waves. So if you look at this particular chart here, could be a 1-day chart, for example. We'll have an impulsive segment where you can clearly identify the waves, wave 1, 2, 3, 4, and wave 5, and then you identify the corrective phase of ABC, and that could be on a 1-day chart. But now you decide to have a look at a 1-hour chart at this point, and what you can see even within one of these phases, from 0 to 1, let's say, you can really experience on a smaller time frame many more opportunities which exist that replicate this kind of wave pattern in a form of a phase. Whereas what you can see on a bigger time frame is more of a linear move, let's say, before you get that corrective pullback. But you can always find waves within waves, because this theory can be applicable to any particular time frame on a price chart. And as the market moves in favor, you can see that this market would look at this kind of phase and will be able to contribute or correlate the impulsive wave, followed by, again, just to repeat myself, the corrective wave. And this can happen over and over and over. So just bear in mind the principle of the fact that you can see and experience and identify waves within waves, and that does arm you with a lot of the knowledge and understanding about Elliott wave theory and how to go about applying it. Okay, so what we want to do is exactly that. We want to show you the 5-wave pattern in practice. how can you go about identifying, these levels and these waves, and what decisions can a trader make to try and capitalize on them? So what we're going to do is we're going to identify some significant areas. We can see that we're getting a little bit of an uptrend impulse here to point number 1. So that would be a potential starting point for those traders that study Elliott wave theory, creating a corrective wave at point number 2. Then we'll see that thrust and this market create another impulse, driving prices to the upside once more at point number 3, before we would then get a slight corrective wave in this particular market before we get a really nice explosive move in this market to the upside. And what a trader who looks to apply Elliott wave theory does is potentially look to get into these markets at the pullback. So they'd be looking very, very closely at this price action here and determine whether they would look to get into this market. And again, if we identified a 4th wave pattern, they'd be looking for opportunities to buy this market. And as you can see, that can be to varying degrees of success. You might take a small winner if you took a trade from the corrective wave number 2. And as you can see, if you got into these prices at corrective wave number 4, you would have experienced a really explosive move to the upside. So that is your 5-wave pattern. But in addition to that, you will also experience a pullback off the high there at 5. So you get your corrective pattern falling into place where you get your low price at A. Then the markets try to push higher and they fail to do so, creating point number B, corrective wave B. And finally, we will see our corrective wave at point C as well. So that is the Elliott wave theory in a very practical sense. So those that trade price action to the upside might then look to look for opportunities to maybe buy at this point, or potentially sell at point number B. Now they have a variety of different decisions to be made around C. So this is where, this is obviously an introduction to Elliott wave theory. So there is a lot more to Elliott wave theory. So hopefully we're just giving you a basic sort of introduction to what Elliott wave theory is. So then what we can see just from this general price action is we start entering and we can see that prices move to the upside. So again, we start the Elliott wave process, potentially giving opportunities for traders at this point to maybe look to buy at these levels at 2 and 4. And of course, it's a riskier trade, but there's opportunities to sell at 1 and 3 as well. However, you must bear in mind that there is consequences when it comes to risk reward as well, depending on whether you're trading the impulsive phase or whether you're trading the corrective phase. So that's just the potential application of Elliott wave theory to a price chart which is moving to the upside, which happens to be the current pound dollar price chart. And let's show you the same situation, and this just happens to be the dollar yen price chart, a very current price chart. And what we can see from this is we can see that prices are this time moving lower. So we create our first wave, we get a pullback, we get a corrective pullback at point number 2. The markets then move lower at 3, they pull back to 4, and they create a low this time because whereas before we were looking for a trending market to push higher. Now we're looking for a trending market to actually push lower. So in this example, now we'd be looking for maybe opportunities to sell at 2 and 4. So and again, identifying these opportunities can be somewhat difficult. you might be presented with opportunities to buy off these lows. However, again, that can impact a trader's ability to manage risk effectively. So we'll discuss a few of these difficulties very, very shortly. But that is the Elliott wave pattern and applying it to a market which is moving to the downside. And of course, we get that corrective phase once more. So we get the pullback to point A. Prices try to break lower and they fail to do so. We get a point B, and then we get our final point C in this market, again presenting some very, very interesting opportunities to different traders at different price points and different wave points as well, whether it's impulsive or whether it's corrective. Okay, so let me just take this off the screen and let's discuss some of the difficulties that traders can experience when they look to apply Elliott wave theory. And there's just a few of them to be aware of. Just going through the last couple of examples there, I'm sure you may be sitting there looking at that screen and perhaps suggesting, right, well, how and why did you decide on those particular points, and how would a trader actually truly look to capitalize on it? Because the reality is there's actually a lot more to Elliott wave theory in terms of your practical application. And because of that, it can be very difficult to use and interpret for new and inexperienced traders. So it is definitely more for those that have a little bit more experience, understanding, seeing and identifying price movements. So it is regarded that those that have considerable more experience of understanding price movement and price action might be in a position to be able to apply Elliott wave theory in a little bit of an easier format. It can also be difficult to identify the beginning of a wave as well. So again, I'm sure you've probably looked at those charts and said, why did you start at point 1? Now, we do so for very specific reasons, but again, a lot of that is more of an advanced sort of aspect to Elliott wave theory. Traders can struggle to identify entries and exit prices as a result of identifying perhaps a corrective low, or 0.2 or 0.4, whatever the case may be. And actually looking to trade that signal is a little bit more difficult. And finally, traders do not always understand the effectiveness as a tool from a risk management perspective. And actually, that's a really quite important one, because if you create a corrective low at 0.2 or 0.4, then those lows can be used as very accurate price points to utilize from a risk management perspective, only if that trader has a comprehensive understanding of risk management. Because if you get a break of those corrective lows, then the principle of the Elliott wave no longer exists. This is really what some of the difficulties that traders can have. It would create what's called structural failures in these markets, and that would actually imply that something else is going to happen in that market, i.e. that first corrective phase fails in terms of impulsing and driving prices to the upside. It actually turns around, reverses, it creates that structural failure, and actually then that market is the likelier outcome is for that market to actually be pushing lower instead of initially pulling higher if we are applying Elliott wave theory. Okay, so that just about concludes this introductory session to Elliott wave theory. So we've had a brief introduction, so hopefully you now know who he is and what the basic principle of the theory is about. We've had a look at the 5-wave pattern, and that's broken down in impulsive waves, corrective waves, and wave repetition, and also the understanding that you may be able to identify and see waves within waves. And Elliott wave theory as well in practice, applying it to a price chart, and then just touching upon some of the difficulties that traders can have when applying Elliott wave theory. So on that note, that does conclude this particular webinar. So thank you very much for joining us on this installment of Courses on Demand brought to you by Forex.Academy. And we do hope to see you all very, very soon. Bye for now.